Hello everyone, this is the market update for the 3rd of July 2025. What a market! The market continues digesting recent trends. The mid-cap and the S&P 500 has made 1.18% and the small-cap Russell 2000 1.03%, led by the charge yesterday, while the S&P 500 and Nasdaq paused after setting all-time highs. The broader tone remained bullish ahead of the holiday breaks on the 4th of July. What has been the key drivers and labor market data? Reconciliation budget bill passed by the Senate, extension of 2018 tax cuts, clear Senate and heads to the House, removing a major policy overhang for smaller companies, and that can explain the rally that we've seen in the small cap and mid cap, and that could actually help the small cap and mid cap finally to rally and to actually start to break out from the channel doing absolutely nothing since 2022 after a fake breakout that we saw last year. So the Fed chair Powell signaled possible job cuts during the ECB summit. Basically, he hinted that the Fed was data dependent but open to rate cut as early as July. And this is quite a big joke because Jerome Powell actually in this very big forum of ECB, he was mentioning that if they didn't have any uncertainty with the tariffs and all the policy uncertainties, they would have cut rates already since a long time. So it really shows that he is not data dependent, he is opinion dependent, he is feeling dependent, but he is not at all data dependent. So stop saying that the Fed is data dependent. This is a big joke. July cut odds sit at 21% and September cut is at 93%, but we should be in for a surprise and have the cut as early as July. So if you see the Fed starting to cut rate in July, that don't be surprised that the mid cap and the small cap will rally and finally break out. So stay tuned for the mid cap and small cap. What has been also supportive of the market is the hiring data has been very good. ADP and Challenger report. ADP private sector unexpectedly shed 33,000 jobs, the first job loss over the last 2 years due to hiring resistance, not layoffs, mainly in financial, professional, and educational healthcare. The Challenger announced jobs cut dropped 49%, which is very, very good, heading to 48,000, illustrating reduced layoff, even as hiring plan pulled back. So overall, the job market is pretty good and in good shape. We are seeing a bit of weakening, but it's nothing dramatic at all. These reports just point to a slowdown in the job growth, not a collapse, and could tilt Fed expectation toward July as opposed to September. So at the macro level, manufacturing at JOLT PMI rose to 52.9, ISM improved to 49. JOLT numbers show 7.78 million opening, all sign of resilience on the job market. Construction spending slipped modestly, but didn't derail the rally. So we know that the construction and the real estate market is actually into recession since over the last 2 years, since actually the rate is at the highest since the Fed started to hike rates to the 5% marks. The real estate market is just dead. So if the rates start finally to decrease, then we should see this construction sector and the real estate sector finally to improve and to rally with the rest of the other sectors. Technical and sentimental setup, SPY and QQQ remain near the all-time high, digesting the gains. IWM is testing the 200 moving average and on the verge of re-entering its March up channel, which actually quit during the collapse of February-March. The VIX old low at 16, implied volatility remains subdued, and TLT stays near the 2007 lows. You imagine 2007 lows. At 87, yield rising, equity favored. Breadth is very strong and momentum is intact. No visible crack on the equity market so far. So what is the market outlook for going forward? Today, NFP is the key catalyst. A weak sprint could confirm ADP slowdown and provoke a July rate cut rally. If employment holds up, expect a high tide that lifts all boats into holiday thin volume. Because we know that the holiday season, there is a very, very low volume. And if the market is particularly bullish during the holiday time, then this low volume will actually means the indices could actually fly up. Small caps are breaking out and the tech is leading, while the rest follow. Monetary clarity plus fiscal stability and data resilience equal momentum remains the momentum. which means the momentum is bullish and the market should remain bullish. So all in all, in summary, despite the slowdown in hiring and market remain laser focused on upside, especially with tax clarity and Fed conscious, and fading macro fear, with no real catalyst for a pullback and data potentially paving the way to a Fed cut, bullish momentum is deeply entrenched and heading into the 4th of July. So if you disagree or if you want to leave your comments on the comment section, please do so. And don't forget to like and to subscribe to help the channel grow its audience. Thanks so much. See you next time.